Hello, welcome to this Capital Economics drop-in. I'm Jennifer McKeown, I'm our Chief Global Economist. We're here today to discuss the outlook for 2023. We published our quarterly Global Economics Outlook at the end of last year. I hope that you saw it. If you didn't, there is a link on your screen where you can request a copy. The key messages from that outlook were that the world was heading into a period of very weak growth, with recession in many advanced economies, and that inflation would fall much faster than most people expect. And that would allow central banks to end, or in some cases even reverse, their tightening cycles later this year. So this session is to take your questions on that. We hope to spend about 20 to 30 minutes doing so. Please ask questions on your screen. You can see a Q&A box in front of you, so keep your questions coming. We have several good ones in advance, so I'll start with those, but any that crop up during the session we'll try to answer, and any we don't get to, there's a lot to cover, of course, we'll try to answer over email after the event. So I'm joined today by several of our chief and senior economists covering all of the major economies. They are Mark Williams, Paul Dales, William Jackson, Andrew Kenningham, and Andrew Hunter. So I'll hand over to them now for some questions, and I'll start with one that's been asked in advance that everybody is asking, in fact, which is the US still heading into a recession? Andrew, could you answer that for us?
Yeah, sure. So, yeah, I think unfortunately recession risks for the US are looking pretty high for 2023. We've obviously had a couple of bits of data recently which have been okay. The employment report we got last Friday with payrolls rising by more than 200,000 on the month was obviously reasonably solid. More generally, it looks like Q4 GDP growth is shaping up to be reasonably okay as well. We're expecting growth of about 1.5% annualized. But I think with these kind of indicators, it's important to remember that they're essentially only coincident indicators. They only really tell us that the economy probably wasn't in recession as of the end of last year. But if you focus more on the sort of more forward-looking leading indicators of activity, they are generally painting a much more downbeat picture to come for 2023. So to take the ISM activity surveys, for example, which we also got last week, they've now both fallen below the 50 mark. On past form, that is consistent with negative GDP growth. The other surveys are all actually giving a very similar message. Add in things like the inverted yield curve, the weakness in housing that we've seen over the past year, and our composite recession tracking models, which sort of bring together the signals from all those leading indicators, they actually suggest that the risks of a US recession within the next 6 months or so have actually now risen above 90%. I think there's reasons to think that any recession this year would be reasonably mild. You know, households in particular going into it in a pretty strong shape financially. But I do think a recession is probably on the way, and we're expecting it to start at some point over the first half.
And that's despite the resilience of the labour market, Andrew. That doesn't change your view.
Yeah, as I said, I think that's only really a coincident indicator. If you look at the headline payrolls figures, actually going back to the employment report, there are a couple of signs, sort of the lesser watched indicators, things like average hours worked and temporary help employment, which do tend to have more sort of leading properties, and they have actually already weakened quite a lot more significantly. So again, consistent with the idea that a recession is coming.
Okay, fine. And I know that you were forecasting Fed interest rate cuts by the end of this year. You have been for quite some time. But the Fed says that it won't be cutting interest rates this year, of course. What do you make of that? Do you feel it's making you feel nervous about those forecasts at all?
Not so nervous just yet. I think, look, the Fed currently is still in hiking mode. As you say, the officials are still sounding, continue to talk very tough on inflation and sounding very hawkish generally. But we do still think the Fed will be cutting rates again a lot sooner than officials are currently suggesting, and probably before the end of this year. I think it's worth stressing that's not just because we think a recession is coming. I think there's a big difference between now and how the Fed has typically behaved over the past 30 years or so, where they would usually pivot to looser policy at the first sign of recession. Now, of course, the big focus is inflation. But I'd probably say really our single highest conviction call, if you like, on the US is that we think inflation is going to fall very sharply this year and a lot more quickly than the Fed seems to be allowing for. I think there's already very clear signs of not just disinflation but deflation in core goods. We're seeing signs of progress in services as well, with rent inflation in particular looking like it's set to slow pretty soon. So when you add in, a recession, a period of labour market weakness, slower wage growth to that, we think sort of all the conditions are in place really for a very sharp drop back in inflation. As I said, I think the Fed will be cutting rates again, probably around Q3 this year.
Okay, hopefully we can come back to the US later, but on Europe, one of the big stories in our outlook is about the energy crisis and the fact that seems likely to drive Europe into much deeper recessions than elsewhere. But it's also, we've seen the wholesale gas prices come down quite a long way even since we wrote that outlook. What's your take on that, Andrew? Is that changing your view of how bad things will be in the Eurozone in particular?
Yeah, thanks, Jenny. Well, it's definitely been a really huge change over the past few weeks. Gas prices now, I haven't checked this morning, but it's probably around 70 euros per megawatt hour. It was about 165 in early December and peaked at over 300. So it has been a dramatic easing. It's still high compared to pre-pandemic levels, but there's definitely been some improvement. But the backdrop is, I think we've seen the Eurozone probably contract in Q4 last year. The data are a bit mixed, but some of the hard data has been weak. The surveys were also very weak. And we think it will probably contract again in the first quarter of this year. But there have been some improvements in some of the surveys since about November, which I think in part reflects this easing of the energy crisis. And that's boosted confidence as well as helping some of the more energy intensive industries which have been really clobbered by the high gas and electricity price last year. It helps a bit with inflation as well. We've nudged down our inflation forecast for the Eurozone for this year. We were already expecting really big falls in headline inflation simply because of base effects as the increases from last year drop out of the year-on-year comparison. But those should be helped, given a bit more of a boost by this fall in the gas price. So we see headline inflation averaging about 5.5% this year. It's currently over 9%. So it'll come down towards the target by the end of this year. However, the one thing we don't think it really changes is the outlook for the ECB. They're already more focused on the core inflation rate, which is over 5% now. And I think that will come down, but more gradually. The ECB's not yet finished tightening. We think they'll raise rates by another 100 basis points and probably leave them at that level, which would be 3% for a year or so. So we don't expect rate hikes until well into 2024.
Thanks, Andrew. And how about the UK, Paul? How does that fit into this?
Well, it's very similar trends to the ones Andrew's discussed because the UK has also been hit by the energy crisis. I think perhaps the one big difference, though, is that the UK's labour force is still well below pre-pandemic levels. And this is hampering economic growth to perhaps a greater degree than in the Eurozone, and also generating a bit more wage pressure, or perhaps it means that wage pressure will last longer. And at the moment, these effects are being exacerbated by the striking action of certain workers in the UK. So that's, I think, an extra layer of developments in the UK. And it plays into our view that interest rates in the UK are going to have to go a bit higher yet, from the current rate of 3.5% to 4.5%, which is a bit higher than the consensus forecast. And it also contributes to our view that the UK's recession is going to be a bit deeper than most people expect, involving a peak to trough fall in real GDP of around 2%. And while we do think the Bank of England will eventually follow the Fed with interest rate cuts, we think that's very much a story for 2024 rather than 2023, due to perhaps wage growth remaining a bit stronger throughout the first half of this year.
Okay, and how about China, Mark? Another big story for this year is Chinese reopening and just how that's going to affect the Chinese economy, the rest of the world. What are we seeing so far, and how do you think things are going to pan out?
Well, as you know, Jenny, we wrote our outlook for 2023 piece for China about a month ago, which feels like an age ago now. The data for December are extremely weak. But also what happened in December, which is the key development really for 2023, is that it looks like the COVID wave passed through China's population incredibly quickly. So although the government is no longer releasing reliable infection data, reports suggest, including from provincial governments, that 70, 80, 90% in some places of people have caught COVID just during the past few weeks, since maybe mid-November. So incredibly rapid spread. And when we look at mobility indicators, the number of people traveling around on subways in the major cities, people out and about on the streets, we're already seeing in many parts of China a substantial pickup in activity. So the sort of process of the COVID wave going through the country and the reopening that in other countries was spread over 6 months, say, in China has really been compressed into about 6 weeks. So it now looks like we're likely to see a significant rebound in activity, potentially this month. I was going to say this quarter, but potentially this month. And that will set the stage for a much sooner, much earlier recovery of activity than we had been expecting. So we've been thinking initially that the first quarter of this year would be extremely weak, and then the recovery would happen. But now it looks like the first quarter actually will probably get a rebound in activity, and that will then set the stage for stronger consumption activity. And meanwhile, there's been other important changes at the in China. The leadership is backing away from the 3 red lines on the property sector. It's also giving quite strong signals that it's backing away from a lot of the tech crackdown. And it's trying to be more friendly to other countries. We've seen, particularly Australia, which in some ways is always the country, one of the countries that kind of gets punched when China goes into wolf warrior mode. They're trying to mend relations there. Now, there's big questions as to whether this is a lasting change in behaviour. I think it's probably more a tactical response to the extreme weakness of the economy at the end of last year. But these are the changes that will set the stage for the way that the economy operates during the course of 2023, and it's now looking like at least the near-term outlook is a lot stronger than we had anticipated.
Okay, we had a question as well, Mark, about the inflationary implications of all this, didn't we? Which I know your team have recently written and note on. Is reopening going to be inflationary for the world, disinflationary? And what about for China?
Yeah, so, well, our colleague Julian wrote a great note on this, which was published yesterday. And the upshot is, at least domestically, yeah, there will be some upward pressure on prices. We're going to see demand coming back fairly strongly. We saw elsewhere that when that happened, there was some dislocation. There was some, the supply side was a bit slower to respond, particularly in things like hotels and restaurants and these kinds of areas where people maybe have lost their jobs over the past year or so. And that will put some upward pressure on prices. There's been less of that sort of dislocation in China there than there had been in other places, in other countries during the pandemic. So we're not expecting a really big pickup. On top of that, although Chinese consumers have money to spend because they've been saving a bit more over the past couple of years, they never benefited from the big fiscal handouts that we saw elsewhere. So they're not really going to go in very big. So there'll be more spending from the consumer side, which will add to a bit of domestic inflationary pressure, but we're not thinking it's going to be anything like what we've seen elsewhere. For the rest of the world, the implications of all this are, one, it takes away one of those risks. People have been very worried about supply chain disruption in China causing problems in the rest of the world over the past couple of years. As China comes out of this COVID wave, and it's no, as we know, it's not one of these things that you only have once and then it ends, but the chances of there being lockdowns aren't going to happen. Factory shutdowns are far less likely. So it takes away one of those inflationary risks. But what it does mean is that Chinese demand for natural gas, for oil, is going to be higher than would otherwise have been the case. So that will potentially put some upward pressure on prices there, particularly, as I say, in the near term. That's where the real perhaps unexpected shift has happened, the speed at which this is moving. So over the first half of this year, I think we'll see a big rebound in Chinese demand. for oil and for natural gas, and also a big increase in Chinese tourism, particularly for the rest of Asia. So places like Thailand, Hong Kong, Japan potentially are going to see a big increase in the number of Chinese tourists arriving.
Thanks. And more generally on other emerging markets, William, Mark's touched on emerging Asia there, but what about the rest of the emerging world? What does China's reopening mean, if anything, and more generally, what is the picture for the developing economies going into this year?
Yeah, thanks, Jenny. So China's reopening, like Mark said, it will help some of those EMs that are dependent on Chinese tourism. And if energy prices rise too, that will provide some support to some of the commodity producers. But I think if you look beside that, there are a lot of headwinds facing the rest of the emerging world. On the external front, you have the weakness in developed economies that we've just been talking about. And at home, you have tight monetary and fiscal policy and high inflation, all acting as headwinds to growth. So on our forecast, we're projecting that GDP growth will weaken in 2023 in about 3/4 of all the emerging markets we cover. Now, within that, there's going to be a big variation. At one end, India should remain a relatively fast-growing economy. At the other end, we're expecting economies in large parts of Eastern Europe, as well as parts of Latin America, to contract over 2023 as a whole. And overall, this would be the most synchronized slowdown in the emerging world in the last 25 years, once you strip out the pandemic and the global financial crisis. I think the one positive we can talk about, looking at the outlook for EMs this year, will be the fall in inflation that we're likely to see. It looks like inflation in most countries has now passed the peak. In some countries like Brazil, it's already come down a long way, which should provide some support to consumers. But even then, I think particularly in parts of Latin America and even more so in emerging Europe, where labour markets look very hot, it's going to be some time before core inflation approaches central banks' targets. So even though we're likely to see interest rates start to come down this year, particularly in Latin America and emerging Europe, the monetary stance will remain very tight.
Okay, thanks, William. There's a question here on the US for you, Andrew. How will the political deadlock in Congress to raise the debt ceiling affect your reading of the US and global economy?
Yeah, thanks. So I guess, everyone will have seen the shenanigans in the House of Representatives with Kevin McCarthy's bid to become Speaker. I think he eventually won enough support, but only after something like 14 or 15 votes, which is nearly unprecedented. But the key issue is that he is currently, or sort of on an ongoing basis, is now beholden to a group of sort of the most hardline conservatives within the Republican faction. So I guess ordinarily, in terms of the implications for the economy, we would, more or less ignore these kind of political wranglings. They don't necessarily have any significant impact. But yeah, as the questioner points out, the one key issue is obviously the debt ceiling. So in terms of the level of federal debt outstanding, it is actually approaching the ceiling pretty rapidly. It's only about $70 or $80 billion short of it, so that it will hit the limit within the next month or two. The Treasury then has a sort of pot of cash on hand to tide it over for a few more months, but it looks like funds would probably run dry sometime around July, August time. And yeah, the sort of key problem is that we basically already know that these conservative Republicans are going to demand big spending cuts in return for raising the debt ceiling, which the Democrats in the Senate and President Joe Biden are going to be very reluctant to agree to. So it's sort of, as usual, a repeat of this standoff in terms of who blinks first, really. I think, our central scenario obviously has to be that the debt ceiling is eventually raised somehow, but clearly there's scope for a lot of uncertainty, a lot of volatility in financial markets in the run-up to the deadline, if indeed they haven't come to some sort of deal before then. And I think it probably goes without saying that the consequences of failing to raise the debt ceiling and risking a US default would be potentially pretty catastrophic for US markets and the economy in the form of probably a widespread surge in treasury yields.
Thank you. Another one for you, Mark, on the Bank of Japan. How does the move away from yield curve control in Japan? What does the move away from yield curve control in Japan mean for investors?
Yeah, so it does look like yield curve control is on the way out. Not really, because I think Japan is developing a lasting inflation problem. I mean, obviously, headline inflation is relatively high, but I don't think anybody expects it to be that high in a year's time. But the Bank of Japan, I think it's the political pressure that it's under right now that could turn out to be the key thing. And of course, Kuroda is about to retire. So we'll have a new Bank of Japan governor in April, and the signals that are coming out of the government are that one of the more likely successors is somebody who has been a vocal critic of Kuroda's ultra-loose policies. So it does look like sooner or later yield curve control will go, and it could happen. But Kuroda could bite the bullet and decide to do it before he leaves, in which case there's a meeting next week and then one further meeting before his tenure ends. We think that, I mean, there's obviously a chance of sort of market spikes in the near term if that happened, although my impression is that most people are expecting some sort of move. The timing is in question, but I still expect yield curve control to go. Our estimates suggest that 10-year yields would rise from the 0.5% ceiling where they've lodged recently to about 1%. So a smallish increase in bond yields. And then I guess the other impact of that to think about is the yen, where again, I think some of this is already priced in, but we would still expect there to be a further leg up, a further strengthening of the yen if and when this happens.
And does it mean anything for short rates, Mark? Sorry if you've already touched on that.
Well, the policy rate, I think, wouldn't change. So there's a kink in the curve at the 10-year point because of yield curve control. So we wouldn't see as big increases as the 50 basis points that we were expecting elsewhere in the curve. And we think that the short-term policy rate would be unchanged. I think, realistically, the Bank of Japan has long said that in order to really move away from its loose policy to tighten policy, it would need to see wage growth at 3%, and it would need to believe that inflation was sustainably above 2%. And neither of those things are true. Neither of those things are likely to be true for the foreseeable future. So I don't think there's a case for lifting the short end, lifting the policy rate. So it will just be the 10-year that changes.
Okay, interesting. Thanks. We've had several questions about fracturing, actually, Mark. Now, we had intended really today to focus on this year, and we are running out of time. We could really only scratch the surface at the moment. But there is a whole page under the key topics on our website about fracturing. We ran a lot of round table discussions with our clients and some drop-ins on that last year, and wrote a lot of focuses. So please do have a look on our website if you're interested in fracturing or deglobalization. But Mark, one of the questions is, has anything changed lately on that front? Have we seen any significant shift? Do you think that we've seen anything that would alter our view?
There's been a lot of interesting changes. I'm not sure that they've fundamentally altered the view. I mean, our view is that the world is coalescing into these broad blocks centered on the US and China. But within that, it doesn't mean that the two blocks aren't going to have anything to do with each other. There are going to be significant trade links and investment links through these blocks. So it's not really a black and white story. But a couple of things to highlight recently. One is, as I mentioned, the signs that China is becoming a little bit less aggressive, if you like, in terms of its diplomatic stature, sort of posture. So it's being much more friendly to Australia, I mentioned. So that's a sign, I think, of it's trying to kind of warm things. One of the kind of the most most wolf warriors in the diplomatic corps in China is someone called Zhao Lijian, who yesterday we learned had been sent to a really obscure post out of the diplomatic service. So it looks like he's been demoted, which I think is a clear signal to those who've been pushing for a very hard line in the Chinese Foreign Ministry. So it does feel like there's been a bit of a shift there. Question though is this a lasting shift? And I think it's probably more a tactical retreat to try to buy some time, to try to warm relations, because towards the back end of last year, of course, the US put some really tight sanctions on China's tech sector. And China really needs time to try to allow its tech sector to stand on its feet. So I think it's a tactical retreat. The other thing that's been going on, of course, is Saudi. Particularly China is warming up to Saudi. Now, in our map of the world with decoupling, we have Saudi as a neutral, trying to do business with both sides. But that, I think, is one of the interesting areas to watch, whether that shifts and whether China succeeds in trying to pull over some of the big oil producers into its orbit. But we'll keep watching.
We will. Thanks for that, and please do look on our website at all the material we have on fracturing, which, as Mark suggested, we will continue to update as and when there are major developments. Also on our website, you'll find our World in 2023 page, which includes various updates, focuses that we've written recently on the outlook for this year, and the risks around that, which I think are really interesting, which we've fleshed out more on that page. Unfortunately, that's all we've got time for today. I think our key messages are that the world is still heading into a period of very weak growth, a recession on some definitions, despite some signs, some more encouraging signs lately in some areas, that inflation will fall much faster than most people expect, that the reopening for China will be a bumpy process, but perhaps not quite as bad as it looked like it might be initially. Nonetheless, growth likely to disappoint in China this year. And that central banks around the world will be able to bring their tightening cycles to an end, or perhaps even begin to reverse them later this year as those disinflationary forces continue. Thank you very much for joining us. We haven't had time to touch on financial markets today, and that's because we have a separate event tomorrow on both financial markets and commodities. There's an invitation to that on your screen. Please do join us for that session. I think it will be very interesting. Thank you for joining us for this one, and we'll hope to see you again soon.